Do you have a professional doing your payroll? If not, you should consider Capital Payroll Systems because they are the professionals. Capital Payroll Systems is the dependable service that provides accurate information and timely service. Capital Payroll is the worry-free service that provides total tax filing and new hire reporting. And Capital Payroll Systems is the personalized service that continually offers unmatched customer assistance and time-saving solutions.
Hi, this is Chris Boyd of Asset Management Resources. We're thrilled with the professionals of Capital Payroll Systems because they make my life easy. I don't have to worry about deadlines or filings and fines. I just talk to Pam or Linda and Terry, and they do all the work. Simplify your life. Talk to Capital Payroll Systems. They are the professionals.
So if you're not using the professionals, call them toll free at 800-298-0008. That's 800-298-0008. Or visit them at capitalpayroll.com. You'll be very glad you did.
Families work a lifetime to develop wealth, and the quality of the estate plan that they get will really drive whether or not that wealth stays with that family or gets dispersed out. The estate plan can really help to crystallize things so that the wealth stays with the family, with the intended recipient. I think that's an important part of what we're trying to do. To me, my clients are like a part of my family. I hope they feel the same way about us, but I certainly feel that way about them. I just want to be there to help them and guide them through the difficult time that they're about to go through. And if we can take any of that burden off of them, that's important.
Call 508-775-7800 or visit boydandboydpc.com. Your family will be grateful. You create the legacy. We create the plan.
The following is paid programming. Welcome to Something More with Chris Boyd, certified financial planner practitioner and founder of Asset Management Resources, LLC, a registered investment advisor firm. We call it Something More because we like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients across the country, your host, J. Christopher Boyd.
This is Something More, and I'm happy to have you with us. I'm joined again by Jeff Perry, and this episode we have Brian Regan, our firm's Chief Investment Officer, joining us to talk about portfolios. So thanks for being here, Brian.
Thanks for having me, guys, as usual. I'm going to ask all the listeners and yourselves to deal with my voice. I'm battling a cold throughout the whole Regan household these days. So.
Well, yeah, I hear you. It's going around here too. I got to start with a little bit of fun though.
I'm all fired up, so it should be a fun show.
All right, that sounds good. Let's do it. So, in any case, it's that time of year where colds are going everywhere, and you can't avoid it. So, anyway, hope you're feeling better. We want to talk a little bit about portfolio construction. I think this is one of the things that any investor can relate to, thinking about how do I approach this? Where do I begin? What do I need to be thinking about? What are the range of considerations that a professional thinks about when setting up a portfolio? And, what can I take away from this? So let's jump right in. And my first thought is, if I'm talking to a client, and you might have other things to take this in a different direction, Brian, but first thing I'm going to think about is what's the client's risk appetite? How tolerant of volatility are they really willing to endure? And that's going to maybe be a factor in my thinking about how much, what kind of direction, what's the asset allocation I might want to be thinking about for a client as the way to structure their portfolio. Does that resonate with you?
Yeah, I really think it starts with you guys getting to know the client. Those many hours of time you get to know the person and get to know their financial situation. I think that informs their ability and tolerance to be able to take risk. And everybody has biases, right? So sometimes if your political party is in charge, for example, you might feel like you can take more risk. You might be more excited. If the market happens to go up, you might think you can take more risk. If the market's going down, you might think you don't want to take as much risk. But I think it starts with you guys and getting to know people and their goals and how to plan for them in the long term. It starts with the financial plan to really understand, where we should be targeting for on the risk spectrum.
And that plays its part in thinking about how much of what assets do we want to use in trying to compose a portfolio. And similarly, so that what do I mean by that? How much stock, how much bond,
Right.
The amount of cash that we're going to retain. And then beyond that, though, each one of those categories has different subgroups within it and how we might want to think about which ones to include, which ones to exclude. That becomes a little more challenging. And of course, a moment in time may influence some of those considerations as to which categories of subclasses we do and don't want. And how much do you think valuation is a driver in that thought process behind the asset class selection or subcategory selection?
Yeah, that's a good question. I mean, it starts with if you're tolerant of more risk, you're probably gonna have more stock in your portfolio. If you're tolerant of less risk, then you're gonna have less. And it's just kind of a general basic rule. Stocks are significantly more risky than bonds. The reason because it's ownership in a company or organization, and bonds are contractual obligation for somebody to pay you. So one is much more inherently risky than the other. So I think it starts there. Now, when it comes to valuation, I think it's the best tool in your tool belt for allocating capital. And why is that? Well, most people are pretty horrible at timing the market. What you'll realize if you spend enough time in this business is that forecasting is it's a crapshoot. People don't really know one way or another. Even the best are going to be wrong a significant amount of time. It's almost like being a great baseball player. You still get quite often. So valuation isn't really reliant typically on too much forecasting. It's evaluating something based on where the price is today and what value you expect to get out of it. Now, that's obviously a lot easier with bonds than it is with stocks because it requires some forecasting to value a stock. But with bonds, you know what the payout's going to be, and it should be a little bit easier. So, I think one of the first tenets of buying and allocating to the bonds is your yield to worst, or your starting yield when you buy a bond, is likely going to be your long-term annualized return, or at least your best guidepost. There are some reasons why that might not be true. For example, your yield to worst assumes that you reinvest all your dividends at the exact same yield that you start at. And obviously in year 5 of you holding a bond debenture, that's not going to be the case. The reinvestment rate is going to be much different than it is in year 1. There's a whole host of different kinds of bonds too, and how they amortize and how they pay off, different credit profiles. So all these things are very important. Maybe I'm getting off a little bit of a tangent here when it comes to valuation, but you might look at a yield and say, hey, based on what Brian's saying, I just want to buy the company with the highest yield. Well, that's not necessarily a good idea either, because high yield bonds, for example, are more correlated with your stock portfolio. And investment grade bonds, at least historically, maybe not recently, but historically are more correlated with a treasury rather than stocks. And
and to your point about the high yield bonds, there's more that credit risk means there's a difference in the risk of how likely they are to pay you back and to pay you along the way.
Right.
And that can have its own
Yeah. So those are some good basic, things to keep in mind when you're evaluating the credit risk of a bond and how that plays into the yield to maturity or the yield to worst. The yield to worst is basically the yield maturity, but takes into account that a bond could be called at some point in the future, and a call is a specific feature in a lot of different kinds of bonds. I think I'll stay on bonds for the moment, but again, you should, if you lend some money to somebody for 10 years, you should expect a higher interest rate than if you lend somebody money for 6 months. That's generally the case. This is what people call the term structure of interest rates, or you should get a liquidity premium. That's not the case in the market right now. So a lot of the things I'm going to talk about are good rules of thumb all the time. But one of the reasons why I don't like a dogmatic rules approach to asset allocation is the world changes, prices change, and you need to be ready to take advantage of opportunities when they're given to you. And right now, and I've felt this way for the last 2 years, I feel like we're all being given a great gift by being able to take very minimal interest rate risk and actually get a higher rate of return.
It's a great point. So, you've talked about some of the bond considerations. Do you want to share, some of the, do we move to stocks as well?
Sure. So
valuation and such?
Yeah. So when you're thinking about, from a macro viewpoint of asset allocation, there's a few levers that you can pull to try to gain a little extra performance, right? It's harder with a macro portfolio when you're buying, the broad market than it would be for individual stocks to outperform, because by definition, you're buying typically ETFs and mutual funds that track the market fairly closely. But there are some things that you can do. So if the market is particularly cheap, right? If I do a analysis and I think that fair value is 4,500 on the stock market and it is trading at 3,800, well, you might want to overweight your stock portfolio, right? So if I have a client that has a conservative risk profile, that generally means around 50% stock, I might go as high as 55, and if I'm really bullish, maybe even 60%. That would be a pretty extreme example. There's a bunch of levers you can pull before you start to overweight stock, especially underweighting stock, because it's really hard to get back to neutral once you underweight stock. Because once the market goes down and you're right, it's really hard to buy. You really have to guess that twice. But what can you do? You can change your beta. So beta is a relative volatility to the market, right? So if I'm using the S&P 500 as my benchmark and it has a beta of 1, I could, for example, if I'm bullish, target of a beta of 1.2. And then I'm on average over time, that means I should get 20% more return than the market if it goes up. And that could also mean I could get 20% more of the decline if it goes down. So that's something that you should keep in mind. And if I'm particularly bearish, if it's the other way around, based on, let's say, again, I think fair value is 4,500 and the market's at 5,500, I might want to underweight beta. I could go to 0.8 or something like that. You could actually do both, right? You could, in a really extreme example, you could be underweight stock and underweight beta. That would be a very conservative position relative to your benchmark. And I probably wouldn't recommend that, but under some extreme scenario, it might be a good idea to do. You could also lean into different sectors, different sizes. So the large cap stocks in the US are pretty much dominated by technology and communication. This isn't a surprise to most of you, right? You Microsoft, Apple, Google, Facebook, NVIDIA, these are the biggest companies in the United States. And they're all technology and communications companies. Now, let's say that you wanted to get more exposure to industrials, real estate, materials, then you might want to go smaller on the capital structure. So smaller companies. Smaller companies often means smaller margins. It often means more debt. Often means more volatility. So these are all things that you want to consider. So more volatility is going to increase your beta. So you don't want to consider the size of the sector that you're allocating to independent of your beta, because it's gonna change your beta. If you wanted to increase your beta, for example, you could buy small cap stocks. You would accomplish two things by doing that, right? You would increase your beta, so you would have a more significant leverage to the market, and you would also have more exposure to industrials, real estate, materials, banks. So that's a lever you can pull. You can also do growth stocks or value stocks. I don't generally love that categorization of stocks for a variety of reasons. But oftentimes growth stocks do well when interest rates are low and falling, and value stocks also do well in that environment. But if rates are going up, typically, not all the time, but typically, quote unquote value stocks should hold up better. They will also be negatively affected by rising rates, but less so than growth stocks. Now, this isn't, again, the reason I don't like the categorization is because this is largely dependent on the types of balance sheets these companies have. So, If a company is highly levered and is considered a value stock, it will be more negatively affected than a growth stock with a clean balance sheet that's actually, has good cash flows and profits.
Just as an aside, Liz Ann Saunders of has recently done a really good podcast to kind of elaborating on some of these challenges where, pure growth versus generally growth, or pure value versus generally value. It's the way how it's critiqued or categorized or classified can be radically different and can change the allocation of how people think about these things. There's some real challenges, but people still use that terminology very often as one of the ways they think about some of the way market forces work. So, but in reality, someone like yourself is really looking at it on a different approach, where you're really looking under the hood, so to speak, as to the balance sheet of the company.
I mean, it's a shorthand, but it can be a very dangerous shorthand. I'll give you an example. Would you consider Costco a value stock or a growth stock?
Yeah, I don't know.
I can make an argument for either side, I think.
Well,
ordinarily, I think you'd think of it as a value stock, though, right?
Well,
I don't know.
No?
Well, what do you consider a value stock? Like, what's your criteria?
I'm just asking. I think it's growing pretty nicely, though. So in terms of its profitability, right? So you'd probably be inclined to classify it as a growth stock, right?
Or do you look at
relatively expensive? It has a PE over 30.
Right.
It grows at a consistent clip of 10+% a year.
So it fits more into that
it fits
profile.
into the growth bucket, right? But what do they sell? I mean, it's
by industry, you
grocery
think of it more as a
part,
value.
right?
Yeah.
Right.
Yeah, you wouldn't think of it as a value category.
Right. So, at the same time, I can think of a company, that's in the tech space, for example, that might have a price to earnings ratio of 14. But for one reason, and it grows at an aggressive clip. But I would argue that that's a better value than Costco. And it would probably be classified, just because it's in the technology sector, as a growth stock. So I just caution people to be very careful about this growth and value type of categorization. It can be very confusing unless you understand what the stocks are underneath the hood of the mutual fund or the ETF that you're buying.
So Brian, when you're building a portfolio in a given asset allocation, I know some of our clients want individual stocks, but most clients are in ETFs and mutual funds.
Mm-hmm.
What's your process, or how do you look at the individual funds and pick which ones to meet the allocation you're looking for?
Yeah. So more recently, I'd say over the last couple of years, we've really concentrated on simplicity of funds. So we do not want funds that can go do whatever they want to do. They're typically called absolute return funds. They can often be like layered in a lot of derivatives. We want to be able to explain what we have to clients, and we also want to know what's in our portfolio at all times. We don't really want to be surprised. So that's kind of the starting point. I was having a discussion with a woman a week ago, and she goes, why did you guys get rid of that fund 3 years ago? And I go, this is just really complicated fund. I can't explain it to clients. It might have done well, but I think we found, an alternative that might be better. The second thing that I look for is cost. One of the greatest ways that you can add value to a client is to keep their fund fees exceptionally low. And we live in a time now where you can keep the fund fees exceptionally low. You don't have to pay loads. There's no trading costs, typically no trading costs. And ETFs, even if they're actively managed, are often very, very cheap. Our internal fund fees are routinely under 50 basis points. They've often been below 30 basis points, which for the industry is exceptionally low. And what do I get out of that? Well, if my competitors are, have internal fund fees of 80 basis points, I think I have a really good chance of outperforming them, just because I'm 0.5% lower per year. So that's a great advantage, right? And then, of course, you want to make sure, especially if you're buying something that's active, that you're in a fund family with a long tenured manager, or at least a good succession plan. So you want to understand that the parent company and the people running the fund Oftentimes in my position, I have the opportunity to meet all these people whenever I want. So that's usually a very good thing. You know, it's something that retail investors don't really have the opportunity to do every day, but it's something that we can do. And then we have what we call core positions and what I would consider satellite positions, right? We have positions that I plan on holding for a very long time. And then there's positions that I'll move in and out opportunistically because, again, I'm trying to add value through asset allocation. It's not a set it and forget it model, at AMR.
What are some other common things people ask about? Style consistency and turnover, and which might imply tax considerations,
Taxes, yeah.
or embedded capital gains, and some of these things, which might not apply in every instance to, like an ETF might have a different implication. It may not be all that relevant, whereas with a mutual fund, it might be very relevant. And of course, where you own the assets can play a role in how some of these kind of considerations.
We've done a big push over the years, and one of the benefits of this is you also keep your costs low of moving from mutual funds to ETFs, because mutual funds do have those surprise gains at the end of the year.
Often.
And this can be very frustrating, especially for people's Medicaid or Medicare.
Right, Medicare premiums with suddenly have an extra tax.
Yeah,
and
all of a sudden they
them
need
to a
to
higher
change
tax
medication. Sometimes I have to change medication because I had a surprise gain. And it can be especially frustrating to have a gain when the market's down for the year. So we have better control over tax considerations by utilizing ETFs over mutual funds. Now, there are times in specific asset classes where I would prefer to have a mutual fund. And I'll give you an example. International stock investing is very, very difficult. Not every country is like the United States, obviously. They have different political regimes, different currencies, different trading partners, different types of governments.
accounting practices.
Even in Europe, they have, they use IFRS. They don't use GAAP accounting. They have, we own Spotify in our individual stock portfolio. I'll give that example. They have social costs. So it's literally a line item where they have to pay basically a Social Security amount every year that doesn't exist in the United States. So that's just something particular to them that they have to consider. If you're investing in China, there's a difference between a C share and an H share. An H share is located in Hong Kong. A C share is located in China. This used to matter. Doesn't necessarily matter anymore. But there's questions. There were questions whether you would be able to get your capital out from a C share, and people felt more comfortable from an H share. I'm just trying to give some examples on why you want an active manager, why you want boots on the ground, which is probably what you're going to get from a mutual fund over an ETF for international stock investing. So our core fund that we use for international stocks is actively managed mutual fund. And that's, it comes with a little bit of a higher cost that you would get if you tried to find something similar from an ETF. But over time, I think we'll do better there. Now, the international stock fund we're in now, to Chris's point, is different than the one we were in a year ago. The one we were in a year ago, without mentioning fund families or embarrassing anybody, we felt like we had to make a change because they completely changed their style, which conflicted with what we were trying to do in our portfolio. So I was trying to tilt towards growth for our international allocation to get some more beta because we were underweight in our international allocation. It was one way for me to try to catch up with the benchmark while being underweight. And the fund family, specifically the fund manager, was moving away from the growth-oriented stocks that I wanted for our portfolio into more value-oriented stocks. And I found this to be a big problem. So that is the type of thing that we'll look at, we'll evaluate, we'll talk to the people involved, and we'll make sure that we're in the right fund for our clients for the allocation that we want them to be in.
Yeah, and you made reference to it. We've only got about a minute left. So you made reference to the idea of core and satellite kind of positions, and I think that's an important technique that I think you've done well, and that's an important concept that you can have some core positions, but you can complement them with things that may not always be in the portfolio, but maybe a little bit opportunistic around what's happening at the given moment in time, and without necessarily creating huge tax implications, as you make adjustments from time to time. And then maybe at another time, Brian, we'll get a chance to talk about more specifically about individual stock categories and selection and that whole process. But any parting thoughts?
Yeah, just on the whole idea of a core satellite. A core, we think about those are kind of permanent in the portfolio, right? They kind of set a standard that we want that standard to be high. For the stock market, for example, we might have a sliver that's the total stock market, and we know we're going to get a beta of 1 there. And then you can adjust your portfolio around that using satellite positions based to try to take advantage of what the capital markets are giving you. And that those satellite positions, we don't trade them regularly, right? We only change them quarterly because we try to play out a thesis. And when I say we change it quarterly, I really mean we evaluate it quarterly. So oftentimes these satellite positions, they can be in the portfolio for much longer than a year. If we think that the thesis still works and still makes sense. So, I hope that gives the listeners an idea of
Thanks. It's been really helpful. A good topic for us to think about. Portfolio construction, something a lot of people deal with, and I'm sure we'll have an opportunity to talk about it again in the future. Jeff and Brian, thanks so much. Until next week, everyone, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's financial planning, portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at amrfinancial.com or call us toll free at 866-771-8901 or send us your questions to radio@amrfinancial.com.